Hey guys, welcome back to the Web3 Daily Show. Today's market feels like we've stepped off a rocket and landed straight into turbulence. Bitcoin pulled back pretty sharply from its all-time high, now sitting around 115,700. ETH slid too, down to the 300s. And no, there wasn't some big crash or black swan event. It's just that the leverage had gotten way too high last week, and once people started taking profit, it triggered a cascade of liquidations. Classic overheat move. Honestly, it's not even panic selling. It's more like people saw the high, thought they were smart holding on, and then got wrecked when the tide turned from the on-chain data and the ETF flow. There's no real dump going on. It's just that capital doesn't want to chase the highs anymore. Everyone's taking a breather. So personally, I'm holding what I've got, not rushing into anything. If you're not in already, maybe don't rush to buy the dip either. The market's cooling down, and honestly, that might not be a bad thing. Stay cautious out there. When I saw the news about Japan approving its first yen-backed stablecoin, my brain just went, this isn't just Asia's USDC. This is like Tokyo saying we're back in the world of finance. Japan's been making noise in Web3 for a while. NFT task forces, DAO legislation, digital asset policies. But let's be real, it's mostly been talk. This time though, they're putting real skin in the game. The Japanese government said they might approve the first ever JPY stablecoin as early as this fall. Why does this matter? Because right now, in Asia, whether it's Hong Kong, Singapore, wherever stablecoin rails are basically all built on the US dollar. It's always USDT, USDC. We're riding shotgun while the Fed drives. But if Japan drops a fully compliant, fiat-backed, JPY-denominated stablecoin, that's a whole new route. That's not just DeFi, that's institutional-grade clearing, FX swaps, yield products, and a native path for local banks and brokerages to get on-chain. And here's the bigger picture. Japan's got some of the oldest, most conservative capital in the world. Pensions, insurers, massive cash-heavy corporates. If just a fraction of that gets a green light to flow into Web3, game changed. Now, will it happen overnight? No way. There's still KYC, custody, audit layers to build. But if you ask me what's the most interesting regulatory story in Asia right now, don't just stare at the SEC, look east and watch what Tokyo's doing. So coming off that Japan stablecoin story, it's clear the whole country's Web3 stance is shifting. And it's not just talk from regulators. The capital markets are literally putting money on the line. Yesterday, we got hit with another headline. Japan's Metaplanet, basically the country's version of MicroStrategy, just bought another 775 BTC. That's around 93 million USD. Bring their total stash to a jaw-dropping 18,888 coins. What hit me first? They bought this at the top. Not a dip, not a discount. Straight into high volatility, peak level action. That's not fear, that's long-term conviction. Their playbook is pretty straightforward. Raise cash, buy Bitcoin, and turn themselves into a BTC-heavy public company. That alone gave them a unique narrative on the Tokyo Stock Exchange, a sort of crypto treasury branding. And the timing, not a coincidence. The yen is sliding, inflation's creeping back up, and for Japanese investors, Bitcoin is starting to look less like a wild bet and more like a secure offshore value anchor. Bottom line, it's not just MicroStrategy that's writing the script. Asia's got players now, and they're betting big. For us in the space, maybe don't ape in blindly, but definitely pay attention. Because when public companies start going full-on BTC native, that's not just a trend, it's a whole new meta. Let's talk about the recent dip, because honestly, it wasn't really a crash. It was more like a high-altitude cleanup. Bitcoin hit 124k and then pulled back hard. ETH touched 4.7k and now it's hovering in the 4.3 range. What actually happened? Well, the numbers tell the story. First, leverage. Last week's long positions hit near record highs. Tons of people piled in thinking we'd moon past 130k. But when the top didn't hold, it triggered a chain of liquidations. Over $1 billion got wiped in just 24 hours. That's not small. Second, the ETF flows. BlackRock, Fidelity, those big boy spot ETFs, they were seeing big inflows. But over the last couple days, that slowed down hard. Institutions are cooling off too. Third, market mood. We used to have slow pump, fast dump energy. Now it's flipped. We get these turbo rallies. And then suddenly, everyone freezes. Nobody wants to be the exit liquidity. So yeah, this wasn't a rug. It was more like a forced reset. narratives are still intact. Liquidity is still around, but unless you're managing risk properly, you're gonna get smoked, not by the market crashing, but by the market cleansing. You gotta survive the shakeouts to stay in the game. So while everyone's still busy talking about spot ETFs, Coinbase just made a low-key but very real move. They launched nano perpetual futures for SOL and XRP.
And here's the kicker, these aren't offshore casino products. They're registered under CFTC rules, meaning this is fully compliant crypto derivatives built for the US market.
Now you might think, okay, cool, more perp contracts. So what? But if you are an institution, this changes everything. Until now, most regulated funds could only touch BTC and ETH, and even then, only under certain conditions. Altcoins, forget it. They didn't have access to proper tools, and they sure as hell weren't logging into sketchy exchanges to hedge their exposure. But now, Coinbase is handing them clean, compliant pathways to manage risk on SOL and XRP. That opens the door to structured products, volatility, trades, short side plays all the stuff pros actually want to do. And don't miss the bigger picture. The fact that these are perpetuals, not spot, means the market's infrastructure is maturing. We're not just investing anymore, we're hedging, arbitraging, and building real risk systems. So yeah, maybe it didn't pump your bags, but if you zoom out, this is a huge infrastructure milestone. One day, you might see SOL volatility, plays traded from a Bloomberg terminal. This is how that starts. Let's talk privacy coins. Because Kraken just made a pretty loud move, they re-enabled XMR deposits. But here's the catch, you need 720 block confirmations before the funds show up. Let that sink in. That's not just slow, that's hours. Maybe even half a day, depending on chain speed. Basically, you can't trade XMR like a normal asset anymore, not on Kraken. Their reasoning: the Monero network's hash power is too concentrated in one place, making the whole chain a security risk. And that, to me, is a massive shift in how exchanges view blockchains. Think about it. CEXs used to be just bridges. You bring your coins, they help you move them. Now, they're starting to evaluate the networks themselves, how decentralized they are, whether the hashing is healthy, if the chain's even secure enough to support. And if Monero's getting heat like this, who's next? Zcash? Secret Network? Some privacy-focused L2s? This isn't just about one coin, it's about a category being squeezed. So yeah, privacy coins aren't dead, but the gateways in and out, those are getting locked down, and not by protocol, by policy. The real takeaway here, on-chain freedom is cool until you need to cash out, and that's still someone else's playground. So Binance just confirmed that the BAS token will officially start trading tomorrow at 2 p.m. on the Alpha Market. Now, if you've been paying attention, Alpha Market is Binance's way of warming up new tokens, like a test arena, before they hit the main exchange or futures. But the real story here isn't another token is launching, it's how they're doing it. Binance has locked in a whole playbook now. Post the TGE, the token goes through staged unlocks, early access campaigns, and slow liquidity rollouts. And the BAS is a perfect example. People have been grinding tasks and whitelist spots to get in. Hype is there, expectations are high, but Binance, they're holding the reins tight. No pump and dump, no chaos at launch, just carefully managed liquidity flow. And that tells you something. Right now, in this market, Binance isn't just listing tokens, they're orchestrating sentiment. It's not about whether BAS goes 5x or 50%. It's about whether the rollout avoids panic sells, whale dumps, and community burnout. Because in a high volatility market, controlling the tempo is everything. So yeah, this isn't just token news. This is Binance fine-tuning its launch engine in real time. Alright, last one for today. Let's go back to Japan for a second. The blog reported that the Japanese government is on track to approve the country's first yen-backed stablecoin as early as this fall. And apparently, the final framework is already under review. Now, is this gonna move markets tomorrow? Probably not. But long term, this is a big one. Here's why. First, Japan's joining the stablecoin race with real firepower. Hong Kong, Singapore, and Korea all have frameworks, but no one's fully deployed yet. If Japan goes live first, they don't just set the rules, they shape the regional playbook. Second, this unlocks an entire domestic loop. Japanese banks, brokers, payment apps, they'll finally have an on-chain regulated yen to use without routing through USDT or USDC. Third, DeFi might soon see its first JPY USDC pair with real liquidity. That could shift arbitrage dynamics, pegging logic, and FX spreads across the board. And fourth, this isn't just another stablecoin. This is a sovereign currency entering the smart contract world. That means tighter audits, higher expectations, and a new level of legitimacy. So no, this won't moon your bags overnight. But if you're thinking long-term about how real finance merges with Web3, this is one of those quietly massive unlocks. This is how the rails get built. Alright, time to wrap this one up. The biggest vibe I got from today's cycle, markets are cooling but the machine's still moving. On the price side, we've got pullbacks. BTC and ETH are down. Leverage is shaking out. Emotions are mixed, but infrastructure still building, regulation still advancing. Japan's getting a stablecoin. Coinbase is adding compliant perps. Solana's trying to hit real-time finality. Kraken's tightening security on privacy coins. Binance is rolling out new launches like clockwork. It's like we're watching price action take a break, while everything else levels up. None of this will pump your portfolio overnight, but it's how the rails get laid, how confidence gets rebuilt, how narratives get seeded. So maybe don't stare at the charts all day. Zoom out. Look for the builders. Look for the regulators who get it. Look for the infra that actually ships. Because when the next rally kicks in, the biggest winners aren't the ones who ape the hardest. They're the ones who got the thesis right and stayed long enough to watch it play out.